Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. A global sell-off in stocks extends to Asia on concerns. Tariffs and government spending cuts will torpedo U.S. economic growth. Asian shares falling to a 5-week low after the Nasdaq marked its worst day since 2022. We'll be speaking with Yardeni on the market sell-off and why he continues to favor U.S. large-cap stocks. And with the U.S. exceptionalism on pause, we look at what it means for emerging markets with JPMorgan's Jahangir Aziz. All right, taking a deep breath. The global markets are in risk-off mode with U.S. exceptionalism on pause, it seems. Trump's tariffs and government spending cuts affecting economic growth, prompting investors to rush towards havens. Bonds rallying while risky assets such as cryptocurrencies are being shunned. Crude oil, too, slipped on worries around the global economy. Avril Hong joins us now with just how bad markets are looking. Avril, put this in perspective for us, because when you take a look at VIX, you know, it's risen just a tad only.
Well, it's almost 30, right? Which is the highest level we've seen it since August last year. So there is clearly still a lot of volatility. But I guess to your point, maybe things aren't that bad. If you look at U.S. futures, they seem to be pointing to just slight gains at the open for the S&P 500. But note here that it did decline about 1% earlier on this S&P 500 futures, something we don't typically see in the Asian session. That being said, tech is still the pain point. And of course, as we see this risk off, almost full-blown risk aversion, crypto was hard hit earlier. We saw it below the 77K level on Bitcoin. The region's benchmark also saw its worst showing since 2 Fridays ago. Remember that tariff headline-driven market crash. Now, overnight, we saw $1 trillion, right, in market cap wiped off the Nasdaq 100. Flip the board to put things into further perspective for you. It's a lot of that selling being driven by the Mag 7s. And if you look at how they've performed since just after the election, they've pretty much wiped out all their gains. Only Apple and Meta are still higher for that period. But maybe not all is lost. As some of our MLive colleagues have been highlighting, these are companies that have been still able to deliver pretty solid results when it comes to their corporate scorecards. And if you look at earnings expectations, it hasn't collapsed just yet. Flip the board again. Consider this as well. If you look at the US rate cut bets along with the yield on the 10-year, it's the lowest since October, but not yet as low as in August, September of last year. Remember, that was when the jobless rate indicated a recession under the Sam's rule. So maybe markets are just bracing for a slowdown, not yet a recession, Has.
Well, that begs the question about U.S. exceptionalism. It's been a key theme for markets. Is that now on pause?
Yeah, I mean, we're almost seeing the opposite of what we saw last year, right? And Citi has today also just downgraded its view on U.S. stocks to neutral, up its view on Chinese equities, saying that U.S. exceptionalism is on pause. And indeed, today, the declines you're seeing in Chinese stocks not quite as bad as what we're seeing in the rest of the region. And of course, just a day ago, we saw record in terms of mainland buying into Hong Kong stocks. You also have now Manus on top of DeepSeek to give US AI's lead the run for their money, right? So that's an interesting perspective. Flip the board again, because the other side effect to this questions about US exceptionalism is also, remember those billionaires at Trump's inauguration? We saw Musk, Zuckerberg, Bezos, right? They were the richest they'd ever been at that time because of the stock market froth. But if you maybe include Sergey Brin and Bernard Arnault in the mix, and you consider how much their wealth has tumbled since that day, $200 billion wiped out. It just shows you how quickly sentiment has turned in the months since Trump's presidency.
A reversal of fortunes in just 7 weeks. Avril Hong, thank you. Let's get insights from the most famous market voices on Wall Street. Yardeni is president of Yardeni Research. And on set with me in Singapore, Jahangir Aziz, Head of Emerging Market Economics Research at JPMorgan. Gentlemen, good to have you with us. Ed, let's start with you. That reversal of fortunes, we're talking about U.S. stocks shedding about, what, $5 trillion in value. We have the NASDAQ down 5% and what, Dow 900 points low. I mean, how are you making sense of what we're seeing in the markets right now?
Well, I'm not joining the panic. The S&P 500 is down 8.6% from its February 19th peak. So it wasn't that far back that it actually hit a record high. And if you look at the 11 sectors of the S&P 500, only one of them, that's consumer discretionary, is actually in correction territory, which is pretty impressive considering that the Magnificent Seven are down 16% from the February 19th stock market high. So I think the market's actually held up remarkably well in the face of the rout, the major correction in the Magnificent Seven. And so I'm not giving up on American exceptionalism. I think what's happening is a lot of the technological innovations that have driven the Magnificent Seven are now actually benefiting the productivity of the S&P 493.
If U.S. exceptionalism is on pause, how long is this pause, you think?
I don't think it's going to be very long. I think right now we had some very overvalued Magnificent Seven stocks. They were selling at a forward PE of 30 a few weeks ago, and now they're down to 26, maybe 25. So we've had a significant correction in the valuation multiple, but these are still great companies. You know, a lot of them are cloud companies. There's still a tremendous demand for cloud, and that's only going to increase with artificial intelligence. So this idea that they're spending all this money on data centers and it's not necessary, I think that flies in the face of the fact that they've got tremendous demand from customers to do more computing on the cloud and more storage on the cloud.
The thing is, Ed, despite your optimism that, you know, U.S. exceptionalism is possibly on pause, there's data out there suggesting that the U.S. economy is weakening. That can be seen from the latest data. And of course, when you take a look at U.S. policy uncertainty, that is at the highest level in 25 years. So surely that may have an impact on sentiment.
Well, there's a really high noise to signal ratio in the economic data, just the way there is in the political realm these days. But for example, we all are familiar with the Atlanta Fed's tracking model for GDP, and that now shows a decline of about 2.5%. And that was after showing an increase of about 2.5% only a few days ago, actually. A lot of that had to do with this bizarre surge in imports during January, and everybody thought that was companies front-running tariffs. Some of that was what was happening, but they were also front-running tariffs on gold bars. I mean, there was a huge imports of gold bars during January, and that's not something that's going to be sustainable, or that's going to, I think that's going to be reversed in February and March. Also, we had the coldest January since 1988. And as a result of that, retail sales declined sharply, as did overall consumer spending. And I think that's going to be reversed in February and March, and we'll see consumer spending make a nice comeback. And the same thing goes for employment. Employment growth did slow in January and February, but I think it's going to make a big comeback in March and April.
Jahangir, let's take into this conversation. Sure. How are you reading this meltdown?
Look, I mean, we had, going into the year, right? So let's say we were in, early January. I think almost every economic forecast, every strategy forecast, including asset prices across the board, was essentially based on one theme, which is not only continued U.S. exceptionalism, but more intensified U.S. exceptionalism. So clearly, positioning has a role to play in it. And even before the meltdown of the last week, we had seen U.S. exceptionalism being pushed back by the asset market. both Chinese stocks, European stocks had been outperforming S&P 500 even before that. I think the additional factor that has come into play is last week. Last week, we saw finally Germany actually putting out a fiscal policy or a fiscal spending package that can have a significant impact on not only infrastructure and defense stocks, but I'm leaving defense out, so I don't know very much about it, but infrastructure can have a significant impact on both near-term and medium-term growth of Germany. Recall, Germany and the languishing of German industry was one of the key reasons as to why we had this pessimism about Europe. So we had the market was pricing extreme pessimism about Europe and extreme optimism about Europe exceptionalism. I think Europe exceptionalism, it depends on what word you want to use, pause or is fading or is getting tarnished. That is true. And there is actually belief that Europe, with the new shift in policies, will actually perform better both near and the medium term. So it's a combination of the two of them. Which is being reflected in the market action that we see today. And then, of course, there are these policy uncertainties coming from the new administration of the U.S.
So on the back of that, it does seem like investors are cutting exposure to U.S. stocks. Is this a buying opportunity if you're looking at a longer-term time frame, if your risk appetite is higher than most people? What are you doing right now?
Well, look, in my opinion, the jury's still out on whether these stimulus programs that the Chinese government has put together to boost consumption and whether the German program to improve German industry, I think the jury really is out on whether these things are going to be successful. I mean, I think we know that given the American attitude towards defending Europe, that a lot of spending is going to go on defense, and I guess that can be stimulative, but it's not really going to make Europe suddenly an economic powerhouse. Europe really lacks a capital market that is as vibrant as the American capital market, that's constantly providing financing for new ventures, for new technologies. And China has a rapidly aging demographic profile, and I don't think they're going to be able to stimulate their consumers. So I think, yeah, the stock markets in Germany and China have had a nice run here, but I think they're going to kind of fizzle out once these realities come into better focus. And I think, meanwhile, the U.S. economy is going to turn out to be remarkably resilient in the face of what we're seeing as a lot of chaos and confusion coming out of Trump 2.0. But I think the economy handled the tightening of monetary policy in the U.S. remarkably well over the past 3 years, and I think that's going to continue to be the case. So I think there's tremendous value here in the Magnificent Seven and a lot of technology names, semiconductor names. I think those names are going to turn out to be good values. I think this is a buying opportunity and not a reason to panic out of U.S. stocks or to greatly change asset allocation away from the U.S. Towards either China, India, or Germany or France.
So, is Citi wrong? Citi downgraded the U.S., upgraded China to overweight.
Nobody's wrong in this business. Everybody has an opinion. That's all there is to it. You know, I mean, at the end of the day, the market tells you whether you're right or wrong. So nobody knows right now who's right, who's wrong. I guess we can come back in 6 months or 12 months or whatever time period. But look, China's been a frustrating market for a long, long time. It's been a tremendous underperformer for a long, long time. And I don't see that there's anything radically changing in that regard. And, you know, the Europeans just really totally botched up the transition, transition from fossil fuels to clean energy. The clean energy doesn't work. It's not reliable. They are going to be extremely dependent on natural gas from the United States. And they also have a geriatric population. And on top of all that, there's a lot of social tension between immigrants that just aren't really melting into the the societies over there. So I'm not that impressed by what's going on over there. And sure, they're going to spend more money, but I don't know that it's going to work.
Jahangir, are you impressed with the measures taken by China right now? I mean, Citi upgrading China to overweight. I mean, that's quite a turnaround in terms of a call.
Look, again, and as Ed pointed out, these are views, right? And the point I was trying to make is that you have to look at the these positioning based on where we were back in January, where, as I said, there was an extreme positioning towards U.S. exceptionalism, and that everything else was more or less dead and over. I think that is essentially that's changing, right? So if that means overweight China, probably Citi is right. But if you look at the Chinese policies, right, the Chinese policies that they have undertaken starting from the fourth quarter of last year, it still remains more or less directionally the same. You are putting out more fiscal stimulus, but the fiscal stimulus still is geared towards increasing production. Now, in the minds of the Chinese authorities, they are doing it to support consumption. Look, we're in Asia. No Asian government ever gives out handouts. It is almost against our DNA to put out handouts. So we believe that the best way of providing or boosting consumption is to giving a person a job. But the problem with giving a person a job is that the person actually produces something. Let's say it's a widget that they produce. And therefore, you are increasing production. But if you're not increasing consumption at the same pace, what has plagued China over the last 2 years is that production has recovered much stronger than consumption. There's a massive overbuilt of inventories across the board, and that is beating down on prices. We've had the last print, which was again deflationary, and it is being exported through export price deflation. So I think as long as China's fiscal policy is directionally continues to be geared biased towards production, China will face problems. It is not that they can't push growth up. I can produce lots of things and push growth up. The question is, what is the cost of that? And the cost of that in China over the last 1.5, 2 years has been deflation, and we do not see that going away. Similarly for the housing market.
Right.
You can do policy changes to try and slow down, for example, the pace of price adjustment. But if you slow down the pace of price adjustment, then all you're doing is prolonging the quantity adjustment, which is essentially what's happening right now. That if you look at the quantity adjustments, whether you're looking at fixed asset investment in real estate, whether you're looking at actual home sales, we're looking home starts, they're continuing to bleed. And the reason is that you are not allowing the entire price adjustment to play, which is painful. I'm not saying that it's not painful. It is a painful thing, and I can understand from a policymaker's point of view, because a painful price adjustment will be detrimental to net worths of the middle class. I understand that, but you're still going to have that adjustment going through.
So the economy is still lackluster. It is in deflation, and despite all of that, we've seen a rally in Chinese stocks. I mean, that's on the back of DeepSeek, that's on the back of Manus recently. Would you dip your toes, buy some of those promising China stocks? We've seen such a massive rally for the likes of Alibaba, for Baidu, Tencent.
Well, you know, the government changes its mind on a regular basis with regards to encouraging business versus regulating business. And right now, the government's trying to make nice again with entrepreneurs in China, especially in the technology field. They want to encourage them to come up with more AI. But what they're coming up with is open source, and open source doesn't really make you any money. I think what we're going to find out is that AI turns out to be a commodity. The head of Microsoft recently basically made that point, that AI and large language models are becoming commodities, and the way you monetize it is by having products that incorporate AI. Microsoft has plenty of those products. And again, I think a lot of it goes to the cloud and the need for more cloud computing. And those tend to be American companies. I mean, clearly there's Chinese companies that are involved in that as well. But I think you get just as there's much opportunity in the United States. I think those Chinese stocks were cheap for a while. They've had a nice rally here. Maybe they're still relatively cheaper, but I think at the end of the day, the capital spending and the demand, which is the key factor here for the digital revolution, is going to be led by the United States.
And we had one investor saying that 2025 is becoming a year of investing dangerously. How would you be investing for the year? I mean, how would you position? How should your portfolio look like?
Well, it's funny. I mean, the past 3-4 years, at the beginning of every year, I was thinking of writing a piece called, 2020, a year of investing dangerously, and then 2021, 2022. Every year seems to be a year of investing dangerously, and we only know after the fact that it wasn't so dangerous after all. We made a lot of money in the past 2 years, for example. People, were totally freaked out about a possible recession in 2020, and instead in 2022. Instead, there turned out to be amazingly great buying opportunities back then. So yeah, it's always dangerous, and it feels awfully dangerous now. We had a real significant sell-off, but yet the S&P 500 is down only 8.6%, and NASDAQ is in a correction territory. But after the kind of rally we've had, having a correction is not a tragedy at all. It's a buying opportunity, in my humble opinion.
Add very quickly, what's the one asset you must have for 2025?
Well, it's funny. The one thing I actually feel fairly comfortable with in terms of the volatility is gold. I've never recommended gold, but ever since I was told that central banks, particularly the Chinese central bank, are just day in, day out buying gold, I said, okay, let's go for a ride with the Chinese central bank and other central banks. Ever since Russia invaded Ukraine back in 2022, and America froze their dollar and other currency assets, central banks have been buying gold, and I think that's why gold's going up, and it's done remarkably well without a lot of volatility. Certainly much better than Bitcoin. I wouldn't touch Bitcoin.
Right. All that glitters is gold. Thank you so much for joining us. Ed Yardeni, president of Yardeni Research. Jahangir Aziz of JPMorgan is sticking around. Coming up on Insight, our exclusive interview with the president of Alibaba.com. Hear their outlook for growth amid increasing trade risks. That's coming up just ahead. Keep it here with us. This is Bloomberg. Talk about a constant turnaround, that tailspin in the markets, well, turning positive this time round. Take a look at the S&P futures, setting out to be a positive day for the U.S., pointing to a higher open, currently up by 0.1%, reversing all the losses that we saw slightly earlier. Of course, markets have been pretty anxious about Trump tariffs, also about the possibility of a turnaround in the U.S. economy. Well, still ahead, why Alibaba.com still expects to see its U.S. business grow despite increased trade risks. Our exclusive interview with that president is up next. Keep it here with us. Of course, the market digesting all the information from the U.S., its data, economic data, as well as all the comments from Trump. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, taking a look at the Chinese benchmarks at this point in time. We know that Citi downgraded U.S. equities to neutral from overweight, but It upgraded China to overweight, citing a pause in U.S. exceptionalism. For now, the CSI 300 index down 6.1% despite that upgrade. Worth noting, though, that HS Tech has given up all its losses. It is currently trading flat. I think that's fair to say. The MSCI Asia Pac Index currently in negative territory, down about 1% as we speak. Of course, the tech stocks in China have been going gangbusters. Alibaba, though, currently down about 1%. Tencent also in negative territory, along with JD.com as well as Meituan. Now, Citi notes Chinese tech stocks look attractive due to recent developments, including the AI breakthrough and government support for the tech sector. In fact, China's National People's Congress gathering that concludes today showed a renewed focus on AI, with lawmakers making proposals to promote AI-related education, scale up applications, and regulate social impact. Let's bring in our tech reporter, Annabelle Drew-Lisbell. This NPC looked a little different 2 years past.
Yeah, that's right. I mean, we're kind of used to these events looking very choreographed and very disciplined, but the context of this NPC was particularly interesting given we're hot off the heels of DeepSeek, of course, launched at the beginning of the year, and then also the very public embrace of China's top business leaders, and included, of course, the co-founder of Alibaba, Jack Ma, but the embrace that we saw of those by President Xi Jinping. So the context and the contours of this event looked a little bit different, and so we saw really a lot of references to AI and to tech broadly across the week. But some of the ways that played out is this sort of competition that's emerging now between different regions that want to make their locales the next Chinese AI hub. We saw lawmakers as well proposing a draft of different ideas from promoting AI-related education. We've already seen, for instance, Beijing school systems saying they're going to start in September 1 of this year, 8 hours of AI-related classes per year. There's scaling up the technology's applications to boosting R&D, regulating the social impact as well. So lots of different discussions were had across the course of the week. And of course, from very notable figures, for instance, from the head of the CSRC, we heard the finance minister, the central bank governor. I mean, it's really a theme that is cutting across a lot of different industries in China now.
And Alibaba, in particular, has been one of the big winners in China. You were able to speak to them. What did you learn?
Yeah, that's right. I think if there's a stock that stands out with the AI theme this year, it is Alibaba, or at least one of the best ones. Given we've seen this huge run up here, you can see 60% year to date or thereabouts. It is off that them being a beneficiary in this with the AI cloud and their range of AI products. But there's also the e-commerce turnaround as well, and we're seeing that being underpinned or spearheaded by Zhang. But what's interesting is a company or a business within the Alibaba group that sort of is at the intersection of both of these, the B2B wholesale division, Alibaba.com, and I spoke with the president, Zhang, earlier. Take a listen.
We see a lot of kind of growth from U.S. since now we have global supplies in China, in Southeast Asia, in Europe as well. And we believe building a kind of global supplies with more resilient supply chain to help SMBs in Europe is still our strategy. And in the early of this year, we see the U.S. orders, meaning the SMBs, buying from Alibaba.com is still kind of 30% of growth. So I think it's very strong, and we'll keep investing on that.
Do you see that still being able to be replicated even if you've got a lot of trade uncertainties and tariffs that are rising?
I think so. So the first one is that we are providing a supply base all over the world. So now we have more than 10,000 of suppliers in Europe, and also in Southeast Asia, in India and Pakistan as well. So we're not supplying the kind of product only in one country. Actually, it's a global supply. And the second is still demand and supply is the fundamental rules. So all the other kind of turbulence may impact in short term, but according to the current data, there are still a lot of people who is not penetrated by internet or digital. We believe there are going to be more and more people is using the platform technology to do their business. So that is not my kind of concern now.
We had the inflation figures that came out, and they showed that really there's a concern building still around deflation within China, both in CPI, PPI, but you're dealing with businesses that are export oriented. So how are those businesses looking right now?
I think two things that I can share with you. So since the beginning of this year, the search index, both in China kind of search engine, or also the social platforms. So searching Alibaba.com and the global trading actually increased by 3 digits. It's like 118% of growth, which indicate that more and more people is interested to go global. And also the new sellers onboarded on Alibaba.com actually is growing very fast since last year. So we believe there's still a trend. And also one thing more that we can add to it is AI technology. So previously, many of the Taobao or Tmall suppliers, if you ask them, do you want to go global? I think the answer are all yes. But when they learn that they need to overcome the language, the time difference, the foreign exchange, custom clearance, all this stuff, then it's a little bit hesitant. So now all these layers is kind of is built on top of the new technology. And now we are lower the barrier for everyone to do this business. I think this is another angle that we impact and improve the kind of confidence for the suppliers.
To underscore what we heard there, so Zhang, who's the president of Alibaba.com, that's the B2B wholesale e-commerce division within the AIDC group, very optimistic still about the outlook despite these rising geopolitical tensions. And one of the ways that they're optimistic, or one of the ways that they're looking at achieving those sorts of growth rates, is through the use of AI.
Timely get, Bell. Thank you so much for that. Our tech reporter, Annabelle Jewelers. And Jahangir, Aziz, head of emerging market economic research at JPMorgan, is still with us. So we're hearing the right noises. I mean, sure, the government playing nice with the tech players in China. We're seeing a stabilization fund. We're seeing relief for local governments. I mean, is that enough to perhaps sustain the feel-good momentum, the feel-good sentiment among investors today?
Look, I mean, on the private sector's confidence, clearly that was broken by a series of decisions that the government took that appeared arbitrary, back from, Alibaba's itself IPO being cancelled back in November of 2020, Didi's IPO being cancelled. You had a very vibrant, large sector called, private sector tutorials that suddenly overnight was changed into non-profit. You had restrictions on the amount of time that you could spend on gaming. And these were seen as being arbitrary in the sense that there were no real commercial or economic reasons as to why you would do something like that. Those still remain in play. So the overtures that are being done, and this is not the first time that the Chinese government has done the overtures. If you go back to July of last year, the Politburo of the CCP put out almost like an 8-page document talking about the importance of the private sector walking hand in hand with the state-owned enterprises. Now, these overtures are important. They are important first steps. The question is, do these overtures get converted into something much more tangible in terms of the private sector coming back into the growth model of China? The problem is not with manufacturing. The problem is with services sector. So it isn't, look, at the end of the day, all manufacturing is digitized more or less. It's hard to imagine any factory floor that is not run with robotic arms. So you're not really going to get the kind of employment growth that you need. These are people who are coming out of universities. You've seen the data on unemployment among the educated. So what you really need over there is service sector growth. And the question is, does the Chinese, what have you heard from the NPC, etc.? That isn't really pushing service sector growth. It is not pushing high-end services. It is pushing high-end manufacturing. There's no question about that. AI-related this, AI-related that.
But he has talked about pushing consumption, wanting to address consumption and the jobs market, for instance.
Absolutely. But what do you need to do that? You need to make sure that the precautionary savings of a Chinese household goes down. you can't really magically do consumption without actually doing its counterpart, which is saving rate has to come down. So what is it that the Chinese government has to do to bring down the precautionary saving? One clearly is the uncertainty surrounding your own employment future. That clearly is one of them. But there are other things that they need to be done, which is savings for old age, savings for healthcare, savings for private education. All of those things need to be brought down. And we've been hearing this almost for 20 years, that there is going to be significant reforms taking place. That hasn't happened. On the consumption side, they are not going to put out handouts. The Chinese government has never done that. No, as I said before, Asian government hasn't done that. So you have to remove that uncertainty about jobs. But what jobs, where are the job creation that is possible among the educated? It is high-end services. It is not necessarily high-end manufacturing. That is not going to give you the job, give you the kind of employment. And lastly, I would say I'm going to go back to the housing market, because housing market is critical, because it is the largest part of a middle-class Chinese's net worth. That housing market needs to be corrected. But if you look at what is it that needs to be done in the housing market, there are structural reforms that can be done on the housing market to find a much more durable solution.
Right.
And that is, the starting point of that is to reform the hookah system, which could unleash a significant amount of demand coming from the migrants who have been living and working in these large Tier 1 and Tier 2 cities. But that still hasn't happened. We have talked about that. It still hasn't happened.
So still lots of challenges, yet the government is having a 5% GDP target for the year.
Yes.
Some say it's going to be difficult to achieve that. I'm just wondering, what do you see the PBOC doing this year? Some say it has to do at least what it did last year, 100 basis point cut for RRR, and perhaps 40, 50 for
I mean, we have similar numbers. We have 100 basis points of RRR cut. We have about 30 basis points of this thing. But if you look at what PBOC is doing right now, PBOC has given more or less up on their favorite instrument, which used to be the medium-term financing instrument, MLF. They have now moved to actual open market operations and using reverse repo as their current effective policy instrument. Now, these are all liquidity generation instruments. The problem with Chinese TSF growth is not that the cost of funding is too high, which is why people are not seeking out credit growth. The problem with TSF growth being at 7.5%, 8% is that there is no demand for credit growth. If you take away the bond issuance, which they include in TSF growth, and just look at bank loan growth, it has more or less been stuck at that 7.5% rate. And therefore, what has to be done is for demand for credit. So PBOC is doing a valiant job. PBOC will keep lowering the cost of capital. PBOC is going to keep pushing liquidity in the market, but it isn't a supply problem that is keeping TSF growth down. It is still a demand problem. So you're back to square one. What is it that is holding back demand in China? And what is again holding back demand is confidence among the consumers to increase consumption, move towards more domestic demand. They have been trying to use investments and supply side, production as their way of doing, and that has come at the cost of deflation.
And you said that PBOC will do what it needs to do. What will it need to do to continue to support the currency, the yuan? Because we've had Trump coming out to say, you know what, there's currency manipulation going on.
So that a long time back, we would call it the $1 million question. Today, we call it the $1 trillion question at the minimum. So that is a strategic choice to me. Strategic choice in the sense that it is part and parcel of China's response to what it faces on the trade front. So if you go back to 2018-19, in 2018-19, tariffs were raised from an average of 3% to about 21-22%. Let's say a 17-18% increase in tariff. In response to that, the PBOC allowed currency to depreciate by 13%. So broadly, it was a 70% offset of the tariffs was done by the currency. If you look at what PBOC has responded in that 20% increase, 10-10, over the last 1 month, it has been significantly lower than that 0.7 beta. So my sense is that this is part of China's overarching response to the tariff threats. We don't know where the tariffs are going to end up. We actually have 20 percentage points more tariffs that we think will be imposed on China by the third quarter. My guess is that once they understand the landscape of what the tariffs are on China, that is when I think you will see what the currency is being used to do. I don't think it is simply a question of supply and demand, that if trade balances go up, currency is going to appreciate, or capital flows will come in, which it has. The currency will get, it provides support to the currency, but not as a strategy.
Jahangir, India's just joined a trading day in negative territory in line with the rest of the region. India is also the other country that's facing Trump tariffs, reciprocal tariffs.
Yes.
And the implications could be tremendous for India's economy, which is lackluster at this point in time. How are you assessing India's economy, which is struggling to find new growth drivers?
Right, exactly. So I think there are two parts to it. There's the tariff part to it, and then there is this part to it.
And together, they ain't looking pretty.
Yes, but let's face it. So Trump talked about in his speech to the Congress about that India imposes a 100% tariff on imports of U.S. cars. I'm not sure what the number is, so don't quote me on it. But let's say they impose a 100% tariff on imports of Indian cars. Who buys Indian cars in the U.S.? You can impose those tariffs, but do they effectively make a difference? Right. So the issue with India is that in much of Indian tariffs is sort of protecting its nascent industries, and you can argue whether it's a good thing or bad thing.
But policies like immigration, for instance, will impact Indian companies, even if those tariffs don't.
That's right. But legal immigration will, but it's not tariffs per se. The tariff that will hurt India depends upon what you call reciprocal tariffs. If reciprocal tariffs is simply current tariffs in the U.S. will be raised to a point where, let's say, India or China, everybody else has tariffs, then I don't think that the impact is going to be significant. But that's not what the U.S. administration is only thinking about. It is thinking of including VAT. If the tariffs imposed by the U.S. now includes the VAT imposed, whether it's by Singapore or by China or by India or by Europe, then the tariff differential becomes significant.
Will that be complicated for the RBI right now in terms of wanting to cut rates? Will that limit what it can do?
So that goes back to the question that you asked right in the beginning, which is that if there is a risk-off in the world, will we do what we traditionally have done, run to the dollar as a safe haven? Or do we move to Europe this time as a safe haven? See, if you look at historical episodes, when we ran to the dollar as a safe haven, or the U.S. as a safe haven, we ran to the U.S., apart from the fact there's a reserve currency, that's usually the euphemism everybody throws around, but we ran to the U.S. for reasons. It had better policies. It had better institutions. It had better capital markets. Yet Ed talked about that. All of those were the reasons as to when to the U.S.
So now you're saying, given where the U.S. is right now, given policies, we're running to Europe.
What I'm saying is that we could be running to, in a global risk-off, we could be running to Europe as a safe haven. If that is what hits not just India, but Asia in particular, that we do not see a appreciation of dollar strength, but we see euro strength instead this time around, then I think that the fears that most Asian central bankers have, which is that if they cut rates, they are going to trigger financial instability, FX depreciation, is actually tempered quite a bit. In which case, whether it's RBI or BI or anybody, will have significantly more space than they would have otherwise had in order to cut rates. And if you look at the central banks in Asia so far, despite the looming fears of tariffs, despite the looming fears of the dollar strength, they have been cutting rates almost across the board.
Great insights today. Thank you so much for joining us. Jahangir, Aziz of JPMorgan, plenty more ahead. Keep it here with us. This is Bloomberg. The Philippine government says former President Rodrigo Duterte is under police custody after the International Criminal Court issued an arrest warrant following an investigation into his deadly drug war. Let's bring in our Manila Bureau Chief, Manolo Serapio, for more. Manny, I mean, we saw this coming, but the fact that it's happened, it's still quite a surprise.
I know. It's like, so we had this story from the weekend where he went for an unscheduled trip to Hong Kong and said that he's ready to be to go to jail. I guess he has heard that an ICC warrant was forthcoming, and then finally it happened today. So basically, the President Marcos's communications office confirmed that the Interpol Manila received the arrest warrant issued by the International Criminal Court. Basically, this is zeroes in on their investigation of the former president for his crimes against humanity, and his legal counsel has responded saying that they are hoping he would be detained in the hospital because he's 79 years old. He's basically he's turning 80 this month.
What is the position of the Marcos government on this?
So basically, when Marcos assumed office, he shunned the ICC investigation. He was saying that because the Philippines has withdrawn from the ICC as a member in 2019, that was during Duterte's term, that the ICC has it's no longer accountable. The Philippines is no longer accountable with the ICC, it not being a member. But then later, late last year, at the same time that the feud between the Marcos and Duterte camps has deepened. It's like he said that basically the Philippine police will cooperate with Interpol in case the case is referred to them, and this is what we're seeing unfolding right now.
Manny, might we see reaction from Duterte's followers and supporters?
There should be. So we've seen some supporters converge at the airport shortly after his arrival, and we also saw him. I think what happened in Hong Kong as well was him telling his supporters that this was coming, and he was seeing some support there. He might have been. I mean, we're not seeing the previous sway that he had, the influence that he had, but his base remains strong, especially in the southern island of Mindanao. And he, of course, he has his daughter, the vice president.
Manny, thank you so much for that. Manolo Serapio, Manila Bureau Chief, and leaving you with the benchmarks across Asia in negative territory. That equity sell-off continuing, and that is it for Insight Horizons Middle East and Africa is next. Keep it here with us.